Nick Curry,
Here.
Dan Jansen,
Here.
Christine Hoffman,
Here.
Brandon Maresma, Eddie Vergara, David Cohill,
Here.
Marvin Dupree, Rudy Dean, John Gostilla, Jason Sharp,
Here.
Gaylord Candler,
Here.
Ed Dawson,
Here.
John McDaniel,
Here.
Lance Huish, Debbie White.
All right, we have a quorum for all three boards. Great. Moving on to approval of minutes. You have the minutes for the joint quarterly meeting from November 9th, 2022 in front of you. May I have a motion for approval?
I move that we accept the joint quarterly meeting held on November 9th, 2022.
Second.
We have a motion and a second. All in favor signify by saying aye.
Aye.
Any opposed? Motion carries. Is there any old business? New business? Is there courtesy of the floor on here? Oh, we do that at the end. Okay, so new business, we'll start with the General Employees Board. First item is to approve the application for retirement of Dennis Faulkner, AS400 Systems Analyst, retirement effective March 1st, 2023, separation date August 19th, 2022, meets age and service requirements for deferred retirement, 10 years of service. Can I get a motion from the general employees?
I move that we approve the application for retirement of Dennis Faulkner.
Second.
We have a motion and a second. Any discussion? Roll call, please.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes. And motion carries. Congratulations, Mr. Faulkner. Second item, application for retirement, Michael Coleman, grounds crew leader, backdrop retirement effective January 1st, 2020, separation date 12/30/2022. Meets age and service requirements for service retirement 33 years and 9 months. Can I get a motion?
I move that we approve the application for retirement for Michael Coleman.
Second.
We have a motion and a second. Any discussion? Madam Clerk, roll call.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes. Motion carries. Congratulations, Mr. Coleman. Next up, application for retirement, Lamar Whitaker, Utility Superintendent for Beaches Energy, backdrop retirement effective February 1st, 2020, separation date 1/16/2023, meets age and service requirements for service retirement of 36 years and 6 months of service. Can I get a motion?
I move that we approve the application for retirement for Lamar Whitaker.
Second.
Motion and second. Any discussion? Seeing none, Madam Clerk, roll call.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes. Motion carries. Congratulations, Lamar. Moving on to our consultant report. Brendan, it's all yours.
Good afternoon. Everyone has hard copies in front of you. Would you still like me to kind of go through up on the board, or is it easier to just kind of talk in favor? I'm happy to do whichever.
I like the board.
Okay, great.
We don't present that.
Sorry. Maybe we should rotate the boards around every now and then.
Over there.
the best seat though.
Well, it's all fair.
Oh, half the board over there.
So I'll begin on page number 2. And if you recall from previous years, the first report of the calendar year, we include a letter from our CEO, Mike Welker. I'm not going to read the letter to you, but I do want to just highlight a few things that are contained on that page. First and foremost is a thank you. If it wasn't for the opportunity to work with boards like yourselves, we wouldn't have a firm in the first place. So again, want to make sure you understand how much we appreciate the opportunity to serve. As a reminder, kind of what you had heard last year, we have been committed to reinvest 100% of the profits of the business back into the business, and that for the last couple of years has primarily taken 2 areas, technology and personnel. The short version is that's going to continue for at least this year and kind of for the foreseeable future. So again, we likely continue to update you in that on that progress, but that's really been the focus and is expected to continue to be the focus. The other item that's contained in the letter is an update to the partnership. So as a reminder, ANCO is a 100% employee-owned partnership, but we're in a program where that ownership is being distributed among a greater number of employees. So with that, we're really happy to announce on the top of page 2 that John Breath, Tyler Grumbles, and Brooke Wilson were all granted or added to the partnership this year. So obviously very excited for them. There is a paragraph down below, kind of a little bit of bittersweet news. Donna Sullivan, who is actually our longest tenured employee, She actually was the second employee that came over from day one with Joe Bogdan, the original version. She decided to retire at the end of the year because you have to be an employee to be a partner. She had to give back or sell back her interest back in. So on a total basis, we had a net increase of 2 partners, 3 being added, and then Donna's retirement on the backside. So just wanted to make sure you're aware of that. It technically counts as a change in ownership, although it's within the normal structured program that we've been in for a number of years. On the next page, we just touch on, there are 93 folks that work at ANCO, and obviously you get to see me. Previously, you've seen Dan and a couple other people, but you don't often see, kind of some of the folks in the background. So we'd just like to remind you that there certainly is a very large and extensive team behind us, whether it be in the research area, performance reporting, different functional areas of the firm. We just make sure to point that out so you're aware that obviously it's not just Dan or myself here. There's a big team behind us. Let me stop there for a second, see if anybody has any questions or comments on anything that I've covered so far.
Where are you located?
I'm going to be third down in the top middle portion of consulting.
I guess I'm at physical location.
Oh, physical, I'm sorry. I live here in Jacksonville.
You
Are
mean
you
corporate
the-
headquarters?
Yeah, are you the only one from Anco here locally?
Dan Johnson is actually also here
Okay.
in the Jacksonville area. Yeah, but we are the only 2, and technically we're, if you see our email, it says we're in Winter Park, which is really our only official office in the state of Florida.
Okay.
So in the next few pages, we jump into the market environment. Obviously, the 3 previous meetings, we were talking about very negative results, really across the board. U.S. equity, international equity, fixed income. So the positive news here in the upper right-hand corner is we kind of switched back and had a positive end to what was a very poor year. So you can see the S&P 500 was up about 7.6%. International stocks actually were way out ahead. The ACWI ex-US was up about 14.3%. And then fixed income, which also had been down most of the year, was at least up 1.9%. So kind of good news. We saw broad appreciation across most of the major asset classes. But you'll notice in the bottom right-hand corner, for the totality of 2022, it was still an incredibly negative year. I'll touch on that just a little bit more in a minute. But I'm going to skip ahead to page number 12 and really kind of talk about, again, why we had such a difficult year. I'm focusing on the bottom right-hand corner of the Treasury yield curve. And if you think back, we started the year with the expectation that the Fed was going to raise rates about 0.75% by the end of the year. By the time we got to June or July, not only had we far exceeded that number of increases, but the expectation was they were going to keep raising throughout the year. And so ultimately, we went from this blue line, essentially at 0, to finishing the end of the year where the Fed funds was north of 4%. And it certainly took the market a long time to kind of come to grips with that changing dynamic, continued inflation, rising interest rates. So that certainly had a negative impact on the market. But one thing that you'll notice, from the green line to the yellow line, where we went from 9/30 to 12/31, we did have the short end of the curve move up as the Fed continued to raise rates, and a few of those, out to about the 1 year, the 2 year, did go up slightly. But once you, at the longer end of the curve, we really had no increase in interest rates as the market, again, began to come to the understanding that we were very close to the end of the cycle, and so they were not being as reactionary to the Fed's actions. And so we have seen things calm down quite a bit, and in part lead to the equity recovery that we see here, and also continuing to fuel the recovery that I'll touch on, because January into the first few weeks of February have still been a nice positive move.
But the Fed's also started going down too.
Correct. They slowed down. The last rate increase was a quarter.
The one before that was only half.
I'm sorry?
The one before that was only
A
half.
half and then a quarter. So now they're, I don't know exactly what consensus is saying, but it may be a couple of more quarters. And obviously, employment and some of the economic statistics that have yet to be released over the next few months will help drive ultimately what that decision is. But CPI is slowing. Really, the one thing that's holding up and what making the market think we could have a few more small increases, is employment is staying very strong. As long as that continues to stay strong, that'll help keep the Fed in sort of that slight interest rate increase kind of mode. If you start to see employment roll over or the unemployment rate start to perk up, I would expect that cycle to end faster than perhaps what being expected as of today. The next page is actually somewhat unusual for your presentation, but I thought it was somewhat informative. This is a calendar year look histogram at the S&P 500 for the last 97 years. And so what you'll notice is the negative 18% we had in 2022 certainly was not a good year. But you'll notice that there were 6 years that were quite a bit worse than that number. And then there's a good 5 other years that are sort of within that same range of returns. So all that to say, it was certainly a difficult year for equities, but it was definitely within sort of the normal range of what a bad year is. If you flip to the next page, we'll look at 22 for fixed income, however. This is where, and really in a nutshell, why last year was so difficult for plans like ours. Because typically, when you have equities sell off 18%, your fixed income is up 10, 15, 20%. Not only did that not happen and have a negative year, but it was the worst year in fixed income by a factor of 3, really in history, at least for the last 97 years. The previous worst return was in 1994, where we were down about 3.25%. We're down 13% in 2022. And that really, in a nutshell, is why overall it was such a bad year. The good news, the reason we faced that negative performance is because interest rates were moving up. We just talked about that. Now we're getting yield out of those portfolios. 2 years ago, you were getting almost nothing out of your fixed income portfolio. So now, as painful as this reset was, you're starting to collect 3.5%, 4%, 4.5%, even 5% cash yield. And so you're starting to get that income back where we really had not seen that for a good number of years. Next page just kind of tracks the asset allocation. You can see, on the far right-hand side, we did kind of jump back up the page up to about just short of $104 million. That red line is the sort of the theoretical assumed rate of return line, so we're staying above that. And of course, this is a wonderful looking chart when you think about your cash flow. So going back all the way to 1987, where you only had $11.8 million in the plan. Since that time, not only did you pay out all of that 11.8, but in addition to that, an extra $34 million in negative cash flow. Yet, over that time, you've still grown to that almost $104 million. So it's a wonderful relationship when you've got negative cash flow, you're paying more out in benefits than you're bringing in, yet you're able to continue to grow your assets. And just by way of an update, as of this morning, you were north of $109 million. So call it halfway from where we are up to that next line. So a nice kind of continued jump. Next couple pages talk about the asset allocation. I like page 19 because it shows the deviation from our target. You'll notice we're slightly overweight to domestic, slightly underweight to international, underweight to fixed, because that's offset by the cash position. As you recall, last year and the year before, as we were taking money out of equity, we didn't want to put it into fixed income. We were fearful of higher rates. Thankfully so, you kept it in cash and didn't lose 12%. So it has certainly worked out very well, but that's why it shows that kind of skew relative to our targets, because we're holding that cash instead of putting it in fixed income. All right, with that said, how did we actually do? Page 23. For the quarter, we earned 5.87%, beating the policy of 5.41. You place in the 53rd percentile. So again, our asset allocation is relatively conservative to a lot of public plans. So that's why in a quarter where equities really bounced, we're kind of in the middle part of that category. But you did perform, again, very, very nicely relative to the policy. And if you move out, whether it's the 1 year, 3 year, 5 year, 10 year, you're outperforming your benchmark. And you're ranking well within the top half, usually in the top third of the peer universe. So overall, ranking very strongly relative to the peers, and again, beating the benchmark. Just quickly, a couple of the managers. Obviously, we've got the Total Stock Index Fund, Allspring or Growth Manager, up 1% versus 2.2. difficult year, they were down 32 versus the benchmark of down 29.1. So a little bit behind. Now that's sort of offset by your value manager, JP Morgan, up 13 versus 12.4. For the year, they were down 1.6, but their benchmark was down 7.5%. So very good relative performance. And then Eaton Vance, the Atlanta small cap, really nice quarter, 11.6 versus 7.4. And now for the last year, down 8.7, but their benchmark was down over 18%. So again, very nice relative performance. Then we get into our international managers. Here we actually have the best absolute performance, where each manager was up 13% and change. Really the big change is we started to see the dollar begin to fall in value a little bit against foreign currencies, and that's providing a bit of a tailwind for international that hasn't really been around for quite a number of years. So a nice little bounce on international, but each one of the managers, again, slightly behind their benchmark. And again, that has to do with the growth lean of the portfolio. We kind of talked about that in the past, and I actually have more information to kind of look at that in a minute. But the growth underperformed value, and so that's why these strategies were slightly behind their benchmarks. But again, longer term, both have been quite excellent. Then we've got Sawgrass Fixed, very nice quarter, 2% versus 145. For the year, down 12.2 versus 12.7. So they did outperform, but of course that was in a very negative environment. Then we've got PIMCO Diversified, our non-US income, 4.75 versus 4.7. And for the year, down 13.8, but quite a bit ahead of the benchmark that was down 16%. And then the last piece is JP Morgan, our real estate portfolio. This was the one kind of shining light during our last fiscal year. We're starting to see that kind of roll over. Interesting, when the public markets start to bounce back, that's when you see the private market kind of begin to roll just a little bit. So they're down about 5% for the quarter, although with that we're still up 5% for 2022, which again was the only asset class that really made money in 2022. But we are expecting another quarter, if not two, of sort of some struggles there as they're absorbing some of the write-down. And again, the private portfolios tend to operate on a lag. So, some of the public market pricing that was happening first half of 22 is now beginning to roll into those private market portfolios. So, we should see something similar, but just on a little bit of a delay. Let me pause there, see if anybody has question or comment on anything in the main part of the report. All right, hearing none, let me just give you a little bit of an update. I mentioned the 109 million where we were today, and that gives a little bit of a breakdown. Our equity exposure, which was up overweight by about 2.5%, is now overweight by 3.6% as we continue to see strong performance in our equity portfolios, and in particular, growth. So if you recall, right at the 1st of February is when the Fed raised the last quarter point. It kind of indicated that we're closer to the end of that interest rate increase cycle. Growth stocks, which are the ones that got hurt the most last year, began to pop really when that announcement was made. And so just to give you an idea, our Allspring portfolio so far from the first of the year is up about 9.7%, as compared to the value portfolio is up about 2.8%. So we're starting to kind of see what did well in 22, value versus growth, has kind of flipped here in the early part of 2023. And overall, that 109 million means we're up approximately 4.9%. So when you add the 4.9 to that 5.5 that we talked about earlier, we're sitting, in that 10.5% range, give or take, on the fiscal year-to-date basis. Now I'm going to jump ahead. It's essentially another book that's contained within your report, which is a follow-up from last time. It's going to start on page 53. One of the questions was, as we're facing these interest rate increases and losses in the Sawgrass portfolio of 12% for 2022, and we have this cash. One, what is the cash earning? And is there anything else we could be doing with that cash to stay conservative, but perhaps pick up a little bit of yield from just money market? And so what I did is I created this little short analysis on a couple of different options. On page 54, you can see it's really only two funds in addition to what we've got currently. So I'm showing you a portfolio mutual fund from R.W. Baird, the short-term institutional bond fund, as well as the Vanguard short-term bond index fund. Baird is actively managed, about 30 basis points for that fee. Vanguard is a passive strategy, only 5 basis points. And then I'm comparing it to your current portfolio of Sawgrass. Now understand that when you get to the performance comparisons, it's an apple and orange. You've got a long duration, quality portfolio with Sawgrass and versus a short-term bond fund with either the Vanguard or the Baird.
Is there a time commitment to the bond fund?
There is not. No, these would be daily liquid portfolios, just like any of your other traditional mutual funds. So on page number 55 of the report, it does kind of detail, at least for the Baird and Vanguard portfolios. Right in the middle part of the page, you've got the average coupon. It's 3.1%, 2.3%, 2.8%, as compared to our cash portfolio, or our sweep vehicle, which is now earning 1.25%. A year ago, it was essentially 0, but as interest rates have come up, we're starting to get a positive yield out of that portfolio. But certainly, each one of these does have quite a bit additional yield as compared to just the sweep cash. Performance is kind of detailed on page 57. You really get a flavor for the kind of the duration impact of the portfolios when you look at that 1-year column. So certainly the Sawgrass portfolio we know is down 12 and change. The benchmark was down at 13%. Now our Goldman Sachs, our Treasury money market was actually up 1.38%, so the compounding effect on top of that yield. But you will notice with the Baird and Vanguard, they are short term, but it is longer than cash. So they do take some interest rate risk, or they have some sensitivity. So they were negative, down 3.6 and 5.5 respectively. Certainly a lot better than longer duration, but obviously not nearly as good as the cash position. But now the question is, as we move forward, as interest rates are stabilizing and potentially even falling, is there less risk of that kind of additional loss and interest in picking up that higher coupon, that higher yield over money market? The risk statistics that are on pages 59 and 60 are quite frankly not as useful. Typically when we're looking at a large cap value manager, it's a very much an apples to apples comparison. But because we have longer duration and shorter duration that we're all kind of comparing to each other, this is less helpful than it would otherwise be. But let me kind of just pause a second. I know we had brought up this idea certainly of potentially trying to take a little bit more interest rate risk, get a little bit more yield, but still be defensive. Now that the Fed has gotten much closer to calming down, and I think most folks say we're, and even given current pricing, bonds really haven't moved in the last couple of months, even with the Fed raising another quarter and indicating they may go a couple more quarters. I think the market is now looking past all of that and not really reacting anymore. So with that said, kind of my position is I think it's safer certainly now to kind of dip our toe back into traditional fixed income. So one thing, I don't think we would have near as much risk as we did say 6 months ago by just adding money back to say the Sawgrass portfolio or some portion. But if we weren't comfortable taking that much interest rate risk, then one of these two other options would be a good way to kind of get sort of halfway or a third of the way, from cash, pick up some yield, but not take all of that duration risk.
Seems like there's a little less risk in Baird than there is in the Sawgrass in the long term, no?
Certainly, yeah. I mean, in the shorter term portfolio, yes, you're going to have less volatility, less swings in interest rates, but that also means, over time, it's less yield and less return. In the short run, what's weird, if you think back to the yield curve, in the 1, 2, 3 year part of the curve actually is higher rates than the longer part. So there could be a short-term phenomenon where actually kind of shorter or intermediate term bond funds might do a little bit better than the longer ones, just because those rates might fall a little faster if that happens. But again, That's not a long-term trend, that may just be a short-term.
Sure, I think if we were to go back, things that I would look at Bears, we'd probably look at Sawgrass, to me.
And it's a further diversifier. Within your core US fixed income, you only have the one manager. So this would be potentially adding a second manager to the mix and providing, again, a little diversification, not only by manager type, but also by duration. Because again, Sawgrass is longer, so this would be a much shorter term portfolio.
What's cash release right now?
Like 1.25. So at least we're getting positive yield that we weren't getting a year plus ago, but certainly less than any of the other portfolios that we're looking at here.
With Baird, I think 30% of theirs is in triple B. Does that fit within our investment policy, Dustin? Because our average is an A.
Right, so their average is an A is what we were going with. We were asked this question by Brendan. Brendan sent it to Ashley sent it to me, and we kind of looked at everything and said as long as we're saying the average is an A, I think that fits within our current investment policy.
So as the policy is stated, it's an A requirement at the broad level. So when you have a separate account manager with Sawgrass, you can say you have to buy A or better. But in a fund, you can't impose those rules on them. But the interpretation for these type of vehicles essentially is the average credit quality would apply. So as long as the average credit meets our A criteria, then it would hold. So then the one potential is if the average quality ever dropped below A, then it would force us to take some action.
That was my, because they're at 47% A or lower, and only 53. So if they dropped, we would just be forced at the next meeting to.
Correct. We'd have to make a change. Yep. And again, that lower quality, that duration, that corporate exposure is ultimately why they tend to perform better over time. But certainly you are paying a little bit more for that as compared to the index.
That's what I was about to ask. If you think the 25 basis points in the fee is worth it between the Vanguard and the Baird?
I do. They've been very good about outperforming. And the returns that we looked at were reflective net of fees. So the fee rates that are shown here are actually been deducted from those returns. And just so as a reminder, what we're talking about, we currently have $4.8 million sitting in our money market cash. So one potential move is we just take a piece or maybe most of that and add a new strategy if we're interested in adding one, say the Baird. It seems like maybe there's a little bit of a consensus there. Let's say we take $4.5 million or $4 million, put it in there as a starting point, and then we can continue to look at it. As time goes, we could add or subtract, move between Sawgrass and the Baird portfolio if there's, again, it's not a permanent decision. You don't have to, you're not locking yourself in. But I think that makes a lot of sense. You're essentially getting 2.5 times the yield. You get that pickup kind of right away.
I like it.
Dustin, is this something that we should do in the next section?
And yeah, well, we would probably need to approve the current
Go ahead.
before we make a motion on that. So.
Okay, so based on our discussions last time, Dustin went back to our council to talk about adding an agenda item in case we needed it that was not specific. So you see that there of just where it says possible under B. So I would say we'll continue this discussion under that just to kind of stay with the new procedure, and we'll go ahead and do an approval. Are you finished with the quarterly report?
I'm finished with that. We did have also the follow-up related to international equity. That's in the book as well.
Okay, do you want to go ahead and do that? Go ahead and report on that.
Whatever is best for you.
Yeah,
if you want me
go
to. Okay.
Here we go.
So that begins on page 61. So again, this is going to be a very similar look to what we were just viewing with the fixed income. But we had talked about the international exposure having a bit of a growth lean. And really, before I get there are four funds that I'm putting in here for comparison. And these are the ones that you saw last time. This is really nothing new. But these are mutual funds that range anywhere from 94 basis points with Pear Tree down to DFA or Dimensional Fund Advisors at 29 basis points. So again, each of these are actively managed funds, but within that value category. As we move ahead a couple of pages, again, we've got the different portfolios, number of holdings, This is going to be very similar to what you looked at last time. What I think is helpful or instructive is in this report, I included your current Euro-Pacific Fund and the WCM Fund for comparison purposes. So what you'll notice here, this shows where value is on the left and growth is on the right. Your American funds and WCM is well on that right-hand side, meaning that growth lean. And again, that's why in a year where growth last year was struggling, they certainly were a bit behind. But you'll notice that each of these other strategies that I'm putting in are definitely within that core or on the value side of that ledger. And again, this is where the diversification would come from, more of a value to balance that growth lean within those portfolios. With that said, to me, the DFA or the Dodge and Cox make the most sense because they lean more value than the other strategies. So you can see that one of two ways, either the gray dots or the green dots, or here, the gray and the green, which is sort of like their average. They're farther to the left than each of the other dots. Now again, the next couple pages get into performance. But again, this is an apple to an orange. You have value strategies against growth strategies. You'll certainly see that WCM and American funds did better, certainly over the long term. They've done very nicely. But this is more of a conversation about diversification and sort of spreading a little bit of that international exposure out, including a bit more of that value characteristic. And then obviously we again get into the stats on pages 68 and 69. One I'm going to focus on is standard deviation. That's the height of the roller coaster. How much do these portfolios tend to go up and down? So you'll see Causeway is at 20.5. I'm on the 7-year at the top. 19.1 and 19 for Dodge and Cox, as compared to our current portfolios of 16.8 and 17.2. So actually a little bit more volatile, but again, they will tend to move opposite each other. When value does well, growth will not, or growth does, so they will tend to kind of cancel each other a little bit in that regard. But just to give you an idea of the strategies that we're talking about, Dodge and Cox as well as DFA tend to have the lower volatility and the lower fees. So those are the ones that I naturally gravitated to. And then again, kind of between the two, I tend to like lower fees, so I kind of focused on DFA. But again, like all of the strategies, so would have no issues with any of the other ones, but that's ultimately what I would point you to or suggest if we're interested in adding some diversification within the international exposure. And just to put some dollars behind it, we currently have $11.1 million in our value holdings, which is about 7.6 for Euro-Pacific and 3.5 for WCM. So what the number that popped into my head was starting at 3.5 million, taking 2.5 from Euro-Pacific and 1 million from WCM to fund the new strategy. And that would be roughly a third, or well, more like a half, an eighth, and then about a third.
So that provides a little bit more diversity.
A little bit more diversification. It doesn't, from an expectation standpoint, it really doesn't enhance the return of the portfolio. It's really spreading risk or diversification and get a little more balance within the international. So again, if Euro-Pacific has a bad year, as an example, it would be more likely that one of these strategies would have a good year to kind of help balance that.
That it?
That's it, unless there are additional questions.
All right, we'll go ahead and approve the report by board. If we want to start with police.
So moved.
A motion and a second, roll call.
David Cohill,
Yes.
Rudy Dean,
Yes.
Jason Sharp,
Yes.
And general employees, motion to approve the quarterly investment report.
I move that we approve the quarterly report. Second.
Motion and a second, roll call.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes. And firefighters, motion to approve.
So moved.
Is there a second? Any discussion? For roll call.
Gaylord Candler,
Yes.
Ed Dawson,
Yes.
John McDaniel,
Yes.
Motion carries. So moving on to item B, if we want to get into a deeper discussion on, I guess we'll start with the first one with the bonds.
What did you say our overall cash position was?
4.8, well, it's actually $4.85 million as of today.
And your
mean, I think I said 4.5, but we could do 4 and leave a little bit more kind of for the next round of benefit payments or, I mean, there's no, that's not going to make a huge
I
difference.
think right now cash is king. Of course, that's just today, but I also see the diversification benefit. I don't know that I'd want to personally risk that high number myself, but
Dustin, we're at minus 6.8 on domestic fixed, and we have to bring that within 5.
Not really, because the cash count says, fixed, so it's balanced out.
Perfect.
Really, the limitation is the maximum on equity,
Mhm.
which kind of backs you into minimums on the others. But that's really the one that stands in front of you as the kind of the hard stop.
Fair enough. And do we have any sizable backdrop payments that you know of, or we should keep cash?
We have paid those out. I have none projected until at least December, that I know of.
And because this is a mutual fund, I mean, the administrative ease is definitely there. It's very simple. So you could decide, pick a number, 2.5 million now. And 3 months from now, if you feel comfortable, you just add to it or subtract to it. That part is very simple. You're not really dealing with transaction costs. You're not dealing with anything else. So, you know, whatever if you decide to do something today, whatever you decide is certainly not a permanent decision. You could skew high and peel back. You could start low and add, you know, based on whatever we're thinking as we go.
So we're currently in the Goldman Sachs.
Correct, which is it's a mutual fund technically, but it's like the automatic sweep money market vehicle. That's where our cash goes. If there's any cash sitting there, it doesn't literally sit in cash. Overnight, it gets swept into this Goldman Sachs money market, which is a treasury money market fund.
Is there the Baird, Vanguard, I see are both basically single funds. Is there any benefit of using a transition manager for this transaction out of Goldman into whichever one?
There wouldn't, because the Goldman is a mutual fund.
Okay.
It's a single transaction that comes out as cash,
Okay.
and then it's a single transaction going into the mutual fund. So if we were, say, taking money from Sawgrass, which has 80 positions in the portfolio, and they're selling a piece of each of those 80 in order to raise money, that's where potentially a transition manager might make sense.
Okay.
But here, it's really a single transaction to a single transaction, and there are no individual positions to transition. So it wouldn't matter or be helpful.
what Dustin would the correct way to be make a motion?
I mean, a fairly specific motion on the dollar amount and fund.
I would make a motion to move 3 million into the Baird short term
Using existing cash to fund
with an existing cash.
I'll second the motion.
Let me,
Black Board.
yeah, we need to do this one by board, but, does anybody have any heartache on that before we start doing the motions? Everybody feel pretty comfortable? Okay. I just don't want to start the series of motions and have the last board be the one that, declines it. So we have a motion by Mr. Jansen,
I'll second his motion.
seconded by Mr. Curry. Any discussion from the general employees? Madam Clerk, roll call.
Ed Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman.
Yes. Police board?
Make a motion to move 3 million from cash into the Baird.
Second.
We have a motion and a second. Any discussion from the police board? Roll call.
David Cohill,
Yes.
Rudy Dean,
Yes.
Jason Sharp,
Yes.
And firefighters?
motion to move $3 million into Baird.
Second.
We have a motion and a second. Any discussion? Madam Clerk, roll call.
Gaylord Candler,
Yes.
Ed Dawson,
Yes.
Tom McDaniel.
Yes.
Motion carries. All right. We all just approved moving $3 million somewhere. So there you go. Further discussion on the international equity side of things.
Brandon, what was your dollar amount again for the, out of the WCM and
What-
American?
What popped in my head was 2.5 million coming from Euro Pacific, with 1 million coming from WCM. So a total of 3.5 million going to the new fund. And again, amongst amongst the group, I was kind of leaning towards DFA, but if you were interested for whatever reason in another one, that's great.
I think DFA is really good too.
What, tell me the benefits or the non between Causeway and DFA.
So first is cost. Causeway is more expensive.
Okay.
That's the kind of the biggest example. The other one that I tend to point to, I'll get back to the page where it was.
The one with the circles, how it's.
Correct.
Towards the, yeah.
So if we're trying to balance what's over here, the strategy farthest to the left gives you the best balance. And so when you can get the the best balance for the lowest cost, to me that's what ultimately kind of pointed me in that direction.
Now, I'm sorry.
Go ahead. No, you're good.
Now, for this, is this something where using a transition manager could benefit us?
It would not, because again, it's mutual fund to mutual fund, so you're not dealing in the individual securities. It's just a single trade to exit each of the two funds, and then a single cash trade into the new one.
So looking at page 62, I guess you're saying that there was more risk in Causeway when I'm looking at the management fees. Well, I guess there's a higher management fee with Causeway than there is.
A higher fee with Causeway. If you look at page 60, either 68 or 69, you'll see the standard deviation, which is typically what's used to discuss risk. The standard deviation of the Causeway portfolio is higher. So that, traditionally that would be considered more risky. So you're paying more for a more volatile, more risky fund, and one that I would argue kind of balances against the growth allocation less than DFA or Dodge & Cox.
I mean, am I reading this right, that it's saying that these value investments in international are a higher standard deviation, higher risk than the growth?
They have been, yes.
That is counterintuitive.
It is somewhat unusual.
What could cause that?
Dislocation in the market, us being through a 10-year period where growth has done well, so it has tended to just been more on a line, so to speak. So there hasn't been as much up and down, where value has kind of been left behind, so to speak. And so just kind of relative to overall performance, you have a bit more volatility relative to the rest of the market. But again, what's not contained in these numbers here is sort of there's volatility, but the question is, when does the volatility occur? If WCM and Euro-Pacific Growth have a similar volatility of 16 or 17%, but they're both going up or down at the same time, they're highly correlated, so you feel essentially the full effect. If you pair, say, a value strategy, even if it has a 17 or an 18 or a 19 against a 16 or 17, but they're moving opposite each other, when you pair the two together, overall you actually get a risk reduction. You get more of a balanced impact. So when you just look at standard deviation, that's just height of but it doesn't say when it's happening or what you're pairing it with. That's the one thing. If you look at that statistic by itself, it's in isolation.
I think your suggestion is more of a safety net on diversification than it is growth. Yeah.
Correct. I mean, it will balance returns and balance risk less so an increase in return. It's not really going to change the return expectation for our international holdings. It's keeping where it is. It's really just a risk control.
So Justin, I'm sorry. Yeah. So on, so as far as volatility goes, DFA and Dodge are pretty similar, right?
Correct.
But as far as against the market, the alphas, they're outperforming quite a bit.
Say
It's
that.
the index, right?
Causeway?
DFA is over Dodge, right?
Correct.
And alpha, it looks like Causeway's completely negative, right?
Which page are you on? So if you're,
69.
yeah, 69, the longer term, correct. Because of that extra volatility, they're not giving you enough return after you adjust for the risk. That's what that negative alpha is saying,
And on top of that, we're paying a higher fee.
paying a higher fee for it.
So, looking back, international equity, 1 year, we're down about 25. Past quarter and this fiscal year, we're kind of coming back at 13.
What page are you on, dude?
We're going way back, 24. Looking at our returns. I just question the timing of, are we selling at where we haven't even gotten back to where we are a year ago? I'm 100% in agreement with the diversification. I'm just worried about the timing of, especially looking at the
Is it correctly itself, and it does not too early?
yeah, I mean, when you look at page 66, just in the past year, I mean, our cutesy little Florida State colored bubbles are way down there at the bottom. I'm just wondering, is the timing good now?
It certainly, like I said, it certainly might not be. If you just look at the numbers, you certainly don't want to be selling out of something that is underperformed. I try to look at it through a longer lens. Growth versus value cycles tend to be fairly long-term in nature, averaging 5, 6, 7 years. We've just been through a 10-year growth cycle. The last 12 months have certainly favored value compared to growth. So if we're in a sort of normal growth versus value cycle, then on average you still think that value has some way to go relative to growth. But yes, certainly to your point, in the short run, they are down a bit more than the rest, so kind of counters that argument.
Now, that being said, do we have money still left in cash and the room to move that into being able to diversify, but then maybe look at exiting the growth portfolio when at least it kind of bounces back, being able to jump into the value. So the cyclical nature sounds like to me we kind of be at the start of the wave.
The short version is you really don't. As we sit today, we're at 63.8% equity combined.
Okay.
So we really only have about a percentage point to go. If you're taking any cash and putting it into equity, we're just adding to that number and you're immediately at your cap. So you really would need to be taking it from other equity so as to not increase the allocation.
Justin, do you have the numbers from basically, this is from the quarter and obviously fiscal year from October, what it's done in the last 6 weeks or 5 weeks? Is it still going?
Clear with these funds?
These two, yeah, or the two internationals we're looking at
The-
getting some money from.
They have performed less so than the other strategies the last few, like this year. Because again, the thing I just mentioned about growth, like our domestic growth popping, we've seen a similar thing where international as well, that more growth-related strategies have popped a little bit more recently as compared to value.
I think what you're asking is, this is December 31, how are we looking
The last 6 weeks.
now?
Our funds or these funds?
Just the ones we'd be looking at
Taking money out.
taking money out of.
Okay, I'm sorry. So WCM is up 10.7% since the first of the year.
So that's 10 on top of,
10 on top of the 13 or 13.6 that we got in the prior quarter. Euro,
It's not on top of it, it's the new quarter of it. We're not getting 23%. It's 13 for the year, right?
correct. It is. You're actually getting 10.7 compounded on top of the 13 and change that you got last time. So it's actually more than just adding the two numbers together, because you're getting 10% of the 13, so you actually got an extra 1.3 from the prior quarter return sort of added in. And I'm just doing the quick math here.
you said that was WCM?
That was WCM.
Okay.
So we're up 600,000 on Euro-Pacific growth this year. Which is 8.65%.
Sounds pretty good.
Yeah, I mean, again, growth has popped, relative, in particular, the last 2 to 3 weeks. We saw, the day the Fed cut 25 basis points last, The NASDAQ was up over 3%, and the S&P or the Dow was flat. Like those growth stocks that had been hammered last year really jumped, and kind of the value stocks didn't do anything.
Thoughts on if we wanna take any action
Well,
today?
my personal thought would be, I would be worried to take it something now when it's starting to perform. When compared to where it was, now we're starting to catch back up from where we lost. And if we jump out too early, we kind of screw ourselves on.
Well, I don't know that we're only taking out 2.5% and 1%, so I think.
2.5 million and 1 million.
Billion, right.
So we're talking about a sizable chunk, because I think we're only at 10 million. So we're talking about moving a third of the portfolio that is just now starting to bounce back.
But look how DFA's doing.
I don't have DFA's performance this year,
Yeah.
but I'm fairly confident that it's probably half of what your existing strategies have done.
Well, that makes sense. People on the other end of the spectrum.
Right. When growth tends to pop, they will lag and vice versa.
Could we table this and then like come back to it at the next meeting and just
Certainly.
jump on it then? Like
Of course.
if things change?
I know, speak for myself, I appreciate you brought us to this. I definitely think that it would love to see the diversification in the international equity portfolio. And I just think we should start looking at getting those monthly reports where we're at, and definitely something to look at the next meeting.
I'd like to see what DFA has done too over the past year.
Sure.
Now, that being said, I think we're all in agreement that Causeway, due to the cost and everything else, is just not even, is there a way you could bring somebody that's closer to the DFA and Dodge and Cox and replacing Causeway for the next meeting?
Sure. I don't know. I'll have to go back to the research team, and I don't know how close the other manager might be, but I could. Just so you understand, when I come in the first place, my idea is to kind of try to give you a little bit of a variety within this space. So if we say, no, we really want the more value manager to balance, or no, we want one that's a little bit more toward the middle, you have that option. And so that's why we have the Causeways of the world, but I'm happy to pull them out and give you a couple other ideas that are closer to the DFA strategy.
Yeah, I mean, it just sounds like Causeway's cost doesn't outweigh their returns. They're pretty close to the other managers.
Any other questions on this topic, discussion? So we didn't actually make a motion on this one, so we don't have to take any additional action at this point. And we approved Brendan's report. Anything else that you need to add?
No, by motion, you already did the Baird approval, so we will get that underway.
And
Anything else?
moving on to Dustin's report.
Brendan, I know you've got another meeting to go to, is that? You're good, okay, thank you. Just gonna kind of skip over the plan membership this time. I don't think there's a whole lot of movement since end of year, last year. I mean, we did have, these, couple backdrop payments, that came out. A couple in January that's not on here, that's, part of a separate quarter. And, just had some fairly normal refunds in there. Holiday contribution, Sugarman, Susskind, Braswell, and Pereira sent holiday cards to each of the boards stating that they had made a donation in your honor to the American Red Cross Ian Relief Fund, which is providing shelters and meals to thousands of Floridians affected by Hurricane Ian. So just want to make sure to let you guys know that. We have received those. Software update, I had hoped to have it out by now, but really part of the problem has been me and my time we ran into kind of a problem, and I just haven't been able to get back to it, and I'm about to. We're running into an issue on the accumulated contributions calculation versus Gibber or Smith's calculations versus what the engine has done historically, and we found that major, material wise, you know, somebody who's been here 25 years, maybe Gibber Smith has a $900 difference in how they would calculate the accumulated contribution versus how we currently get it in our system. So we've got to get that official new tracking of accumulated contributions, since the payroll system we're going to be moving to doesn't have the capability to do that. So we've got to nail that down, and I just haven't had the time with everything that we had last quarter with the union contracts and retros and all that stuff.
It's your fault specifically.
Yes, right. So we just had a lot, open enrollment, everything last quarter, so we're just kind of coming out of all that and, gonna get back on the software. Legal update, I did attach a special report from, Sugarman Susquehanna, that Pedro will present at the, May meeting and go into detail on, what this is, how it affects us. By my reading of it, I don't think it's too impactful, at least until 2027. I know that some of these age minimum distribution requirements, age requirements is kind of good for like one employee that we have. So, so that's the biggest impact I can see so far on this. But we'll let Pedro get into that at the next meeting, but I did want to provide it since they sent it out. And feel free to read through that. The next meeting is our large meeting, so it'll be at 2 p.m. on May 9th instead of 3 p.m. We'll have the financial statements, actuarial reports, and budget all in that meeting. And I may be reaching out with some budget questions to any of you going forward here as I start putting the budget together to see what you would like for me to bring.
Second.
Yeah. Yeah, I really stepped in it right there. Other than that, I think that's it. Oh, I'm sorry, we do have a current event coming up after I put this together. FDPTA sent out their announcement of where the next meeting was going to be and everything of the June conference, or their annual conference. So it's not a school, so you would be able to do like your next section. That'd be for the fall, but this is the annual conference, June 25th to 28th at Rose and Shingle Creek. So not sure when they're going to open up those reservations. So it says open in April. So please let me know so I can get you in, because I know this one usually fills up pretty quick. The rooms actually do run out on that annual conference. So be sure and let me know. That's about it.
Okay, next item on the agenda is items for discussion. I would say for the May meeting, we need to make sure we have quorum. We've got a lot going on there. So if you cannot attend, please let Dustin know so that he can make sure everyone else attends as needed. Courtesy of the Florida visitors. No visitors present.